Okay, let's listen to this.
Of the whole game.
So you guys know Raul. He's a bit of a scammer, and pictures coming through on Telegram. Yep. All right, he's a bit of a scammer. I don't think he's particularly insightful. He does run Real Vision, which is a fairly large and influential macro financial press type outfit. So he has far reach. And yeah, so let's see what he's talking about here.
That we're playing at the top level of crypto itself is this debasement of currency, the 8% annualized growth rate of total liquidity, which is the debasement of currency. That becomes our hurdle rate for investing. So I use something called the everything.
8% is a hurdle rate. Not in the United States. Come on now. Globally, maybe, but not in the United States.
Code. And this has been very, very helpful for me. I based it upon the magic formula, which is GDP growth equals population growth, productivity growth, and debt growth. So that's how we understand what drives economies. Once we understand...
Okay, let's go back. They didn't even pause on that at all.
Productivity growth and debt growth. So that's how we understand...
Magic formula, GDP growth equals population growth plus productivity growth plus debt growth. GDP growth. Well, I mean, why? Oh, man, GDP growth is kind of a misnomer. Okay, it's measured differently in Western countries versus China, and also probably Africa, and because in Africa and other certain, not all African nations, but a lot of African nations, there's a lot of black market stuff or gray market stuff that isn't necessarily counted in GDP. I mean, there's a lot of that in the United States too. Look at Minnesota. We're just talking about that. So there's a lot of growth and spending and all this stuff that happens that's not counted. And you get things like CapEx spending that doesn't actually have current day productivity or current day impact, but it's counted with GDP. And China is different too, because the way they count it is that they will spend as much as they're required to spend to get to the GDP number. So they have a goal, grow by 5%. And if they left things, alone, they wouldn't grow at all, or maybe 1%. So how do they get to 5%? The local governments simply spend more money on more infrastructure. Period. That's what they do. And that's not a way to get good growth. That's not sound, sustainable growth. What they're doing is they're actually taking away from people, from the consumers, from the people, and investing it in infrastructure that they won't even use. And they're impoverishing the people to build the infrastructure that's going to be subpar. You've seen the concrete falling apart. You've seen the bridges collapse. They didn't do the right seismic study on the mountains and stuff. You see big sinkholes. You see all this stuff. So it's stealing from the people to construct it to meet the GDP targets. That's not going to last, and it's going to be wasted. And there's a cost to maintain those things. So like if you build a brand new mega airport, which we see pictures of these mega empty airports over there in China, and you have to spend money to maintain that. But it's not even really used. It's not paying itself off. It's not paying itself off of the initial investment, let alone the maintenance costs. So you have to further impoverish your people just to maintain it. So why don't you just let it go and let it fall apart in 20 years? Okay, that's what China's facing. But anyway, back to this GDP growth plus population growth plus productivity growth plus debt growth. Well, debt growth is dependent on population growth to a high degree, not 100%, but within debt, there is an implicit population number in there. Okay, if your population is growing, you can carry more debt. If your population is shrinking, you can carry less debt as a people, as an economy. So implicit in debt growth is population growth. Okay, productivity growth. This is a little bit of a wild card because, we can have productivity growth, but that can go towards unproductive, unsustainable stuff. So like if you look at China, their productivity growth has really, really exploded, but they're productively building unproductive stuff, right? So productivity growth is kind of a misnomer as well. You'd have to dig into that. Like, what is actually the productivity growth here? Is it just paper growth, or is it real growth? Is it wasteful growth, or is it sustainable growth? So productivity growth is really hard to measure. So really get down to the brass tacks of all of this stuff. It's population. That is the biggest single cause of GDP growth. And within that population, so that's quantity. Within that population, you also have quality. So you could have illiterate population or literate population. You can have an advanced, educated, highly educated population, or just a middle education population. You could have low specialization, so it's a primarily agrarian economy, or you can have high levels of specialization. It's a primarily urban society. So there's all sorts of qualitative things around population, but the main thing is population growth. That's the main thing you have to have. So anyway, long discussion. Let's go.
What drives economies? Once we understand that, we can understand the messes we're starting to get into. Trend rate of GDP has been declining for decades now. The population is aging, and you can see from the chart here. Productivity, older people are less productive. So we have a decline in productivity over time as well. Then we start to see debt growth. Debt growth is the big problem that we've been facing for decades now. It blew up in 2008. The private sector has been deleveraging over time. So they've been taking on less debts, and that's been a good thing. But that is entirely offset by the government.
There will be a debt jubilee. They'll just wipe away that debt eventually, especially if we become isolationist and we have other countries becoming isolationist. It's different when you are trying to preserve a global order and everybody to trust everybody. But if you're isolated and your 95% of your economy is within your own borders, you care about your people and all this stuff, there will be a debt jubilee. That's how they will get rid of it. But before that, the natural process is to isolate. So we will be going into a period of isolation, less international trade as a share of global economy, supply chains shrinking dramatically. And once that happens, then they will take it and be able to do a debt jubilee, but not until then.
It's been increasing its debt. And so this debt burden is...
So in other words, this chart right here is a consequence. It's not a cause. Okay, cause and effect. This is not a causation thing. It is a consequence thing. The end of this era, this is what's going to happen. Right? It's not that this is causing the end of the era. This is caused by the end of the era.
The real issue that we're facing today. So that's the birth rate of the total population. The trend growth has been declining forever after the baby boomers. That whole trend rate has been also prevalent in the labor force participation rate, which is the working labor force in the United States. And we've seen the working labor force has been declining and follows exactly the birth deaths rate. So that, if you think about it, means slow growth for economies, difficulty raising taxes, more expenditure for governments, and this is the mess that we're facing. This chart is the most important chart in all of macro, and most people don't understand it yet. This is the labor...
Okay, they're saying I can't hear the video. Let me try to reshare. Damn, sorry guys. Reshare. Audio tab. It said it was sharing audio. How about now?
Force participation rate, and against it is government debt as a percentage of GDP, inverted. Basically, all debt has been accumulated to offset the working age population decline.
How are you guys now? Let me know if you can hear the video if you're still here. Pretty sure it was good now. Okay, sorry about that. It had selected. I don't know why it wasn't sharing.
So they're trying to bolster growth by adding debts. And right now, they kind of have broken from 2000.
Yeah, I missed that last couple minutes.
Inverted. Basically, all debt has been accumulated to offset the working age population decline. So they're trying to bolster growth by adding debts. And right now, they kind of have broken from 2008 onwards. They've broken debt growth. Debt growth is now just servicing of old debts, and interest payments keep accumulating. And government debt to GDP keeps going up. When you look at it in a log channel like this, you can kind of project where we're going to go, which is what Japan did. If we continue as we go now, we will end up by the, let's say, 2030 at 160% of GDP in debt. So it just keeps going. And you can't really stop it because we've got this aging population. And that is the cycle of using liquidity to offset debt. So basically what they're doing is printing money to pay the debt. That's like using a credit card to pay a credit card. That's the whole game we're in. This is the debasement of currency. This is the game.
It's not technically debasement of currency. You guys know that debasement is only possible if it's got a backing. Okay, so 1 unit of debt is still payable by one unit of currency. In the past, it would be, this is 20 grains of gold. Now it's 19 grains of gold. Now it's 18 grains of gold. That's debasement. This is not debasement. And it's not actually, if you're printing money to pay off debt, that is not technically inflationary either. You know, I mean, okay, let's go.
Why the rich get richer because they own assets, the poor don't. Because
it's kind of like recently we've been hearing about repo, and they'll be, oh, there's 34 billion in repo last night, and that's on top of the 17 billion from the night before. But that's not on top of the 17 billion. That 17 billion was repaid, okay? And then they did 34. So it starts from zero every day. That's why it's called overnight repo. But something similar here is going on when you talk about debt financing, printing money to pay the debt. You're burning that money. You're printing it and then burning it, printing it and burning it.
Because they have incomes. Incomes only grow with GDP, and assets go up by the rate of debasement, which is at least 8% a year, plus maybe an inflation rate. So that's the whole game that is being played at every government level right now. We've got $10 trillion of debt to roll in the US alone in the next 12 months. And here's another way of looking at it, is here's the interest payments. The interest payments are what are getting monetized. And so total liquidity just follows the interest payments. So that chart tells you we've got around 7 or 8 trillion.
And remember, the interest rate, that this interest payments, that's somebody's income. So yeah, it's the government has to pay it, but it's going to somebody, right? So as interest rates go down, that means that interest income goes down.
Dollars that we need to print just to cover the interest payments over the next 12 months into the end of 2026, when things calm down a little bit for a while. What we realize within this is the cyclicality of all of this.
Okay, before you get into this, Telegram, you've seen this double sharing up here. I don't know what's going on with my streaming stuff, but I'm seeing a double bar up
It
here.
suddenly became perfectly 4-year cyclical, starting in 2008. And it was all to do with the debt maturity. So 2008, we had a debt jubilee. They forgave all the interest payments and all the debts in all the major economies in the world. And when they did that, they restructured all of their debts. And they restructured them in the 3 to 5 year sector. So as they did that, they created this debt refinancing cycle where every few years they have to refinance all the debt, which requires liquidity. And liquidity drives the economic system. We had this perfect 4-year cycle.
So when is he saying they started this? Because we've had a business cycle forever.
And this is where everybody's scratching their heads right now is, what the hell's going on? Has the cycle finished? That's the big question everyone debates all day. And for me, you can see what's happened here. There used to be this perfect 4-year cycle, and suddenly it's changed. Well, what happened here is we've added an extra year. In 2022, at the beginning of 22, rates were still at 0, and they extended the debt maturity by a year to 5 years. So we've got an extra year in the equation.
Okay, again, one thing I don't like about this is if he's talking about 2022, how come it bottomed in 2023 right on time? It could have bottomed out here in 2024, not 2023, after 2022. So it doesn't quite match up.
So all of the debts that need to get rolled in 2026 and not 2025. So that's why we've had less liquidity than we've expected at this point. You know, the banana zone point in the cycle has had less liquidity. So when we change it to the new 5.4 year where the debt maturity is, this is what we're going to get. So again, it gives you an idea that we're probably likely to peak out towards the end of 2026 in terms of liquidity, as opposed to this year. You can see the changes coming. They're changing things like the SLR, the supplementary
Just for the record, I like this hypothesis a lot, but I think there's some problems with it.
leverage ratio that allows them to sell more treasuries to banks. We're seeing the Fed cutting rates. We're seeing changes in the money market. We're seeing the government ramping up fiscal stimulus. All of this is telling you that the big cycle still remains ahead. So you get this mega trend, which is the secular adoption trend driven by Metcalfe's law in Bitcoin, and it goes up and down. But when you detrend that, it's actually the business cycle. Everything on a year-on-year basis is the business cycle. People don't really understand this stuff. Once you understand this, it makes it much easier to understand how markets move when they move what they do. It's even easier when you know that we've got a predictable business cycle based on debt maturity. So here's the Russell 2000, which is essentially small caps, basically the same. If we go forwards to crude oil, same. If we go through to industrial metals, the same. Everything. Literally everything in the entire investing world is driven by this cycle, and the business cycle has been subdued. Listen to Scott Bessent. He's telling you all day, as is Trump, is we're going to have a banner year next year. Why? Because they're going to jam the market with liquidity, and they're going to jam fiscal stimulus through as well. Yeah, if you think about it, the US is a service-based economy. They're going to get rid of tax on tips. That's a huge boost to people. There's like $1.5 trillion that will flow into the banking system just from that stuff alone, from the big, beautiful bill. Then we've got the changes to the SLR that allows maybe $3 or $4 trillion of credit creation from the banking system. We've got enormous amounts of this stuff lining up. Why? Because they wanted to win the election. You know, the good thing is, for once, we've actually got a macro hedge fund manager running the treasury. So I know how he thinks. He was a long-term global macro investor subscriber. I've known him for 20 years, and he understands the game, which is jam the business cycle going into the elections. So are we at a top, which is the thing that people bleat on all day on Twitter? We're at the top of the cycle. We can't be, because we're not topping in the ISM. In fact, we've not even gone above 50 yet, so we've not had economic expansion. Main Street has been struggling. They need rates to come lower. They need fiscal stimulus, and that's all to come. So when we start looking at forecasting models of the business cycle, here's the interest rate model. That suggests to us that the economy strengthens fast and quite dramatically in the next 6 to 9 months. So that's good for altcoin season. That's good for crypto.
Altcoin season, crypto. Shut up, man. No one cares about altcoin season anymore.
That's good for all risk assets. The correlation of the two things of total liquidity.
Notice he says altcoin season and da-da-da, but he shows a chart of Bitcoin. Come on, man. See, that's why I prefaced this with saying that he's a bit of a scammer.
In Bitcoin are extremely high. In fact, the correlation is 90%. Statistically, that is absurdly highly correlated. When you look at the NASDAQ, it is even more absurdly highly correlated. It's 97.5% correlated with money printing. So money printing is the story that drives this. Liquidity, where are we now? Well, year-on-year liquidity is not very impressive. This kind of slow grind higher has been what we've lived through in crypto from the bottom. It's kind of stop, start. It's because liquidity is not flowing through the system. We've had broken plumbing, and we've had no need to do it yet because we don't have to roll the debt until 2026. When we look at financial conditions, our lead indicator, and put them against total liquidity, well, we've now got a lead, a 3-month lead, and it tells us.
Hey guys, if you're watching on YouTube, like and comment. I will address your comments when I see them. Let me see if I have any from Telegram. Okay. Again, I like this model. All things are kind of pointing to reacceleration. But one thing that I'll point out, we've had spikes in SOFR. We have the demographic issue. We have the China issue. We have the Japan issue. All of these economies are, well, Japan might be accelerating a little bit here because they are doing, a ton of investment into their economy, but they have the bad demographics, so they'll be shrinking naturally from that. China demographics are horrible. They're shrinking. I think they're trying to stave off a Great Depression like reset over there in China. And so there's a lot of, and we have deglobalization with the tariff wars and all of this stuff. And so going forward, yes, there are a lot of things that are lining up for an expansion. There are also a lot of things lining up for continued contraction. And so what is the happy medium for that? And I've talked about this in the chart. So let's make sure this is sharing properly. So if we go to ISM PMI, Purchasing Managers Index, take off these. So like I said, we have different forces that are towards expansion and different forces that are towards contraction. All right. So the base case is continued sideways. That is my base case. There is you could say maybe a slight bias upward here on the ISM. But overall, I would say that this is the base case. And if you don't have this as a base case, you need to say why these other structural negatives are not in your base case. All right. This also matches my base case for the global economy overall, which I just got done on with that big monologue 2 minutes ago about how we're looking at another 20 to 40 to 50 years of stagnant growth. And that would go along with this ISM PMI just going sideways in either mild contraction or mild expansion. So let me draw a better path. So yeah, we could see something like this. Okay. For the foreseeable future. Out many years. So instead of being up like this, dipping down just a little bit, coming up here, dipping down just a little bit. Okay, so instead of this red path, we get the black path, which is minor expansion and minor contraction forever. For a long time. I'm talking lifetimes here, probably like the rest of my lifetime. We could see something like this. That's going to be it for today, guys. Thank you for joining me. Make sure you like and comment if you're watching on YouTube. Also jump over to the Telegram. I'm going live on Telegram as well. We hash it out. There's about, I would say, 50 of us that are real active, but we do have close to 800 members there on Telegram. So come over and join us. Make sure you subscribe to Ansel Lindner on Twitter and Rogue Macro on Twitter as well. So, all right, guys, that's it for today. Thanks for hanging out, and I'll see you later. Bye.